Amitava Mukherjee joins us now, Director with NMDC, to talk about which way the metal prices are headed and what is happening to the iron ore demand. Good morning, thank you for joining us. Now, the dichotomy between global and domestic iron ore prices has amplified in last 2 months. What is the reason for domestic prices staying low?
Good morning. You see, the domestic prices are not really tagged to the international prices directly. We are more sort of calibrated towards the steel prices in India. As such, the policy of the government has always been for a long time that the ore has to be aligned to meet to add value domestically rather than exported. Even if you see the new national mineral policy, para 6.1 again reiterates a long-term government view that the ore extracted should meet first the demands of the domestic industry, not only the current demands but also the future anticipated demand. So accordingly, the entire duty structure has been built around that philosophy, and the current export duty on higher grade iron ore is around 30%, above 58. Below 58 it is of course nil, and the import duty on the other hand is only 2.5%. So this entire policy regime has been for the long time which doesn't really encourage export of raw ore. Rather, it has been the philosophy that whatever value is to be added, it needs to be added domestically. Also, you need to understand that India is the only country which has very substantial steel making capacity. Today it is more than 100. It's around 136 is the capacity. We make around 110, around 107 we make. And we produce, this year we have produced around 210 of ore. No other country has this capability of producing ore as well as producing steel. Australia, for example, produces around 880 tons of million tons of ore, but doesn't have that steel making capacity. Similarly, Brazil, it around produces around 440-450 million tons of ore. It used to before the Vale incident happened, but it doesn't consume that amount of ore domestically. China, on the other hand, produces around 950 million tons of steel, but doesn't have that amount of ore. It has only magnetite, the beneficiated, it is only 330 million tons. Japan, on the other hand, makes steel of more than 100 million tons, but it doesn't have any ore. So the unique situation in India, that way we cannot actually operate in the spot markets and take the immediate benefits of the higher international prices. How the higher prices affect us is through a roundabout way. For example, if there is a high price today, it will lead to a higher steel prices in China, which will lead to a higher steel prices in India, and which we can calibrate our prices accordingly to the higher. So there would be a circuitous way.
So Amitava, sorry to interrupt you here, but just want to get in another view from you. There's a visible uptick in Odisha iron ore production post monsoon as well. Could this be a factor in capping the overall domestic iron ore prices?
No, the production in the Q3 and Q4 has been rather encouraging, of course, even as domestic, even as NMDC is concerned. Overall, India also from 201 last year, we have done 200, and the latest estimate is around 210. Odisha, for example, has grown from 102 to anything between 113 to 116. So that is not necessarily the case, because it has been met with adequate demand. Even if you see the steel production, it has increased by around 7%. It has gone up to 107 million tons, and which is now we are in India, we are the second largest producer of steel. So the ore production has been in tandem with the increase in steel production. So the prices have not been exactly depressed by supply glut, so as to say, within the domestic there has been, of course, in Odisha there has been a production ramp up, because in the anticipated the leases getting expired in March 2020, there has been a production ramp up, but so as to say that there has been a glut which has led to a depression of domestic prices, I don't think that would be very correct to say.
Your own production, despite the problem with Donimalai, has been increasing. So what is helping you?
Oh yes, you see, we had a particularly bad H1 because A, we didn't have an export contract, B, there were the low grade fines were international prices were so less that some major customers did import a lot at that point of time. Then we had a huge monsoon, a 30-year highest monsoon in the last 30 years, which all led to production being severely affected in the H1. But H2, that is Q3 and Q4, we really bounced back hugely. Our production in the Belladela sector has been record breaking in the Q4 and Q4. And in the Karnataka sector, the mine that is operational, which is Kumaraswamy, we touched for the first time 7 million ton, which is the Supreme Court mandated cap. Unfortunately, Donimalai we had to close because of certain disputes with the state government, which is right now sub judice, and we lost around, we could have produced 6 from there, but we could only produce 2.2. So we lost around 3.8 production there. But because of ramping up of production at Bailadila sector and Kumaraswamy touching the all-time high of 7 million ton, so we could actually end up the year with 32.5 in production and sales, which is very good as if you take into account the disruptions, external disruptions that we had in H1 that I had mentioned earlier.
Sense as to when bulk of your contracts are up for renegotiation, and do you think there will be a substantial renegotiation?
No, you see, our deposit 11 that expires in 2037, so we have adequate time for that. The other deposits, they do expire in March 2020. But as you know, the MMDR Act, in the MMDR Act, the government companies have this renewal option where you don't have to go through the auction route. So to that extent, if we apply 1 year in advance, and which we already have, and which so this renewal route for a government company is much more easier. We don't have to go through the auction route for the renewal of our existing mines. So I don't think come March 2020, the renewal of our leases will be a major issue. Unlike the private leases, which will have to be renewed only through the auction route, ours thankfully is not the case. And come 2020 March, I think the renewal will not be a major issue so far as NMDC is concerned.
Likely to give the same dividend what you've given last couple of years, or there could be a change in that policy?
Beg your pardon?
I wanted to understand your dividend policy. You know, NMDC does give a fat dividend payout irrespective of the underlying commodity prices. What is your sense for this year on dividend payout?
The dividend payout?
Yes, please.
You see, the dividend payout, there are government norms that first it has to be a minimum of 30% of your PAT and 5% of your net worth, whichever is higher. And since our PAT is very substantial, so the last we have declared around 585%, which actually accounts for around 39% of our PAT. So there is the norm is also that if you have the money, you can pay up to 100% of the PAT. But then we always seek exemption, and we get that exemption from the ministry because we have what we call it as capex requirements and other requirements, our working capital requirements. So but the ministry does, the government does exempt us from paying 100% of our PAT. But because of reasonably robust profits that we make, so it has been around 39 to 40%. Year before it was around 41 to 40%. Right now, after this 585 payout, it should be around 39% of our PAT, which is fairly reasonable. It gives you a dividend yield post-tax for an investor at current rate of around 5–5.5%, which is fairly a good payout. And among the PSUs, it would be one of the best.
Have a great chatting with you. Thank you so much for taking the time out and speaking with us today.
Thank you.